Money Show, your one-stop destination for all personal finance queries. We have lined up a power-packed show for you where we will throw open the counter to get your mutual fund portfolio queries answered. So do send us your queries on our WhatsApp number 865-797-4571 or email us your queries on themoneyshow@etnow.tv. Thanks for logging into The Money Show. I am Snehi Shah. Now, there are a plethora of funds available in the market to invest your hard-earned money in. But how do you assess which is the right fund for your portfolio? What are the criteria that one needs to look at? Now, to help us answer all of these questions, we are being joined on the show today by Gautam Kalia, the Senior Vice President and Head Super Investor at Sharekhan by BNP Paribas. Hi Gautam, thanks so much for taking the time out and joining us. I'm going to start throwing all our viewer queries at you. And the first query that we are getting today is from our viewer Vijay. And he's asking, are index funds suitable for the long-term investments to achieve a retirement corpus of 1 crore in less than 10 years? He's investing in an SIP of 20,000 rupees in UTI Nifty 50 Index Fund and 10,000 in Motilal Oswal Midcap 150 Index Fund. What is a step-up SIP? What would be a good amount? Could you please help him out here?
So, yes, what I like to say to Vijay is that, the SIP that he's doing is in passive funds. So, passive funds, while they're good, and especially the funds that he's investing in are essentially in the top 100 to 150 stocks. You've got UTI Nifty 50, which is in the top 50, and then the Motilal Oswal, which is in the top 150. So it's in the large and large mid-cap space. So those are good quality companies. So while there is no problem in doing a SIP here with a step up for a long period of time, maybe you want to round out your portfolio by adding a little bit more exposure to mid and small, because you don't have any exposure to mid and small cap. Plus, you miss out on the opportunity of creating alpha when you invest in passive funds and not active funds. So that is something that Vijay can probably consider as an option, as an alternative. Because sure, with passive funds, you're able to save some cost, which is of the fund management fees. But many people end up missing the forest for the trees. You end up saving 1-2% in fund management fees and lose out on 4-5% of alpha, and that really makes a big difference. So that is what Vijay should keep in mind.
Well, Gautam, thanks so much for that answer. Let's move on to the second viewer query, and that's coming from Sahil from Jaipur. Now, he has just started his investment in mutual funds. Can you please review his portfolio and check if he needs to switch any funds? His target is 1.5 crore rupees in 15 years. His portfolio is on the screen. He's asking if he should add more mutual funds or if he should remove any. What would your suggestions be over here? Please guide him.
Yes, so my message to Sahil, first let me just quickly tell him about his funds. So with ICICI Prudential large and mid cap, he should continue that. But with all the other funds that he has, Motilal Oswal mid cap, Tata small cap, Parag Parikh flexi cap, and HDFC Retirement Savings Fund, he should reduce the SIP amount there by about 1,000 rupees. In Parag Parikh, he should reduce by 500. And that 3,500 rupees that he will put less in these funds, that he should put in Kotak Blue Chip Fund. There is very limited exposure in his portfolio for Blue Chip, nearly 40% in mid and small, with another 42% in flexi cap and retirement savings, which is also flexi cap by style. That is why we are suggesting that he builds a allocation to large cap by doing this. Now, when we come to his goal, so his existing SIP is 19,000 rupees, and he wants to create a corpus of 1.5 crores in the next 15 years. So if this portfolio grows only at 12% a year, then he will end up at 95 lakhs. Sahil will be short of his target. So what he needs to do is actually increase his SIP value to about 30,000 a month, so that the probability of him reaching his target goes up. And that's really what we need. Alternatively, he could just increase his SIP value by about 10%, 9 to 10% every year. And that will also help him achieve his target.
Alright, Sahil, I hope that answers your question. Let's move on. Our third viewer query today is coming in from Mihika from Bangalore, and she's planning to invest 20 lakh in mutual funds for a longer period and plan to withdraw money from time to time for personal expenses. Could you suggest appropriate funds that could aid this? And additionally, she'd also like to know if the Motilal Oswal S&P BSE Enhanced Value ETF and the ICICI Prudential Nifty 200 Momentum 30 ETF are good investments to make. What's your take here and what's your opinion?
Yeah, so to Mihika, what I'll start off by saying is that if you're looking to invest in mutual funds and you are planning to withdraw money from mutual funds from time to time, then any investment that you make in an equity mutual fund, please try not to disturb it for at least 5 years. But if you still need some money from time to time, then my suggestion would be make sure that you have an emergency corpus at hand in your savings account that you can access anytime, and then put the remaining money into a portfolio which, because this is an underlying investment, mostly our equity, you should try not to withdraw within 5 years, because the risk clearly is market risk, that you invest today and then the market corrects tomorrow, and that's when you need the money. So that's when you don't really want to be withdrawing, and that's why we tell our clients to keep a 5-year investment horizon at the least. Now, having said that, you are looking to invest and withdraw money on a regular basis. So what you could do is go in for a hybrid fund, which is a combination of equity and debt, which is not 100% equity, so it has a little bit less volatility, and that you could probably invest in. So HDFC Balanced Advantage Fund and ICICI Prudential Balanced Advantage Fund, these are two schemes that you can consider to put this money in, in the form of lump sum. Now, to your last question regarding the ETFs, the Motilal Oswal S&P BSE Enhanced Value ETF has an AUM of only about 80 crores, and the daily average trading value of this ETF is around 64 lakhs on the NSE last year. If you look at the other ETF, there the AUM is only 177 crores, so it's a small, these both are small ETFs, and there again the daily average trading volume in NSE for this ETF is only about 1 crore. So really the problem with both these ETFs is the liquidity. And when there is less liquidity, then there is a mismatch in the price of the ETF versus the underlying securities. And when you need to withdraw the money, that's the last thing you want in terms of pricing risk or liquidity risk. That's why I would suggest that you don't invest in these. Let the ETF market develop a little bit more. Let liquidity in such ETFs become available, plentiful. And that's when you can start looking to add these to your portfolio.
Alright, next up we're getting a query from our viewer Pragya from Bhopal, and she is looking to invest in a mutual fund with the primary goal of maximizing tax savings. Could you provide some good recommendations for good ELSS schemes or mutual funds that offer both tax benefits as well as good returns? And additionally, she would also like to know if it is more advantageous to invest through an SIP or to make a lump sum investment. Could you guide her, and what is your opinion when it comes to a systematic investment plan versus a lump sum? How do you weigh both of these?
Yeah, so, lump sum versus SIP, this is a classic question. Frankly, you should invest when you have the money, and you should try to match your investment flows with your cash flows. So if you're a salaried employee and you're saving every month, then you should essentially do SIPs. If you are running a business and let's say your cash flows are lumpy, then you should do lump sum. So it's as simple as that. Obviously, with lump sum investments, you have a higher risk of poor market timing. Maybe you invest all your money today and the market corrects tomorrow. With SIP, you avoid that risk, but with higher risk comes higher return. So with lump sum, if you invest all your money today and the market goes up tomorrow, so then the advantage is that you put all your money before the market rallied. And in SIP, even if you have a rally in the market, you're investing in a staggered manner, so you're not able to capture the entire upside of the rally. So it works, it cuts both ways in terms of risk and return. That's why we say that you just try to match your cash flows, especially because over the long term, over a 5-year, 10-year horizon, it doesn't really matter. What matters really is discipline and patience in the market. Because it's not just about earning 10-15% 1 year, it's about earning that consistently over a long period. And that's really what helps you create wealth. When it comes to ELSS, sure, you will get income tax benefit under Section 80C. So the schemes that you can consider are Bandhan ELSS Tax Saver Fund and the HDFC ELSS Tax Saver Fund. You can choose from either of these.
Alright, Pragya, I hope that answers your question. Let's move on and take the fifth viewer query today. That's coming from Harsha from Nagpur, and she's looking for an NRI. She's an NRI looking to invest in mutual funds in India. What types of mutual funds are available for NRIs, and also are there any specific funds that are more beneficial for NRIs in terms of tax efficiency or returns? Could you guide her, please?
Yeah. So, the real concern that an NRI needs to have is less about taxation, but more about repatriability. So it all depends where you're investing from. The savings account that you have, is it an NRE, non-resident external, or non-resident ordinary, which is NRO? So ordinary account, NRO account, you cannot repatriate the money. It's basically for income generated in India. And NRE is money that can be repatriated. So if you're investing in mutual funds, your NRE account, then the redemption proceeds will come back to your NRE account, which then you can transfer, you can repatriate abroad. NRO you can't repatriate. So that is something that you have to keep in mind. When it comes to investments, some of the funds that we can suggest, these are not specially made for NRIs. It's just that these are funds that are shortlisted for both resident and NRI clients. So ICICI Prudential Blue Chip Fund, which is a large cap, put in about 30% of your intended allocation there. Bandhan Core Equity Fund, which is a large and mid cap space, put in about 10% there. Mirae Asset Mid Cap Fund, as well as HSBC Small Cap Fund. Here, these are mid and small cap funds. You can put in about 25% here. You can split it equally, or if you have a bias towards mid, you can probably put a little bit more in the Mirae mid cap fund. And then the flexi cap funds, Franklin India Flexi Cap Fund, as well as HDFC Flexi Cap Fund. Here you can combine, put in a total allocation of 35%. So this will complete your 100% allocation across these 6 funds.
Alright, thanks Gautam for that. Next up, we have a viewer query coming in from our viewer Nikhil, who's from Kolkata. Now, he's planning to buy a house in the next 5 to 7 years, and he's also considering mutual funds as part of his investment strategy to achieve this goal. Now, what type of mutual funds would you recommend for the medium-term goal of 5 to 7 years to accumulate funds for purchasing a house? Also, should he consider a mix of equity and debt funds, and if so, what should be the ideal allocation? They're also asking if he should opt for an SIP or a lump sum investment. A repetitive question, but well, yes, a lot of our viewers are having this question. So what's your take over here?
So my answer to Nikhil will be the same about SIP and lump sum. But in this case, I will like to add on one small nuance between SIP and lump sum. The faster you get investing, the faster you can see your portfolio growth happening, and that power of compounding taking place. So in that way, lump sum scores over SIP, and especially when you're not investing over a 10-20 year horizon, but it's very specific for maybe 5-7 years, and you're looking to buy a house. So a SIP will obviously then delay the growth of the corpus you're trying to build versus a lump sum investment. Obviously, you carry more risk in a lump sum investment. But good that you are, considering putting money in equity through the mutual fund route to ultimately buy the house. So that's my answer on lump sum versus SIP for you. But for Nikhil, what I'd like to say is look at the following portfolio, build this, and try to manage your cash flows in a way that you can upfront your investment as much as possible, since you want to buy that house quickly. So again, I don't know the amounts that you're dealing with, whether this is supposed to be a down payment, you want to buy the house outright. I'm just going to share the percentage allocation here. So ICICI Prudential Blue Chip Fund, again at about 25% allocation for your large cap. Bandhan Core Equity Fund, which is a large and mid, where you put in about a 10% allocation. Mere Asset Mid Cap Fund, 15%. HDFC Flexi Cap Fund, 20%. And we are adding a little bit of debt to your portfolio because we want to make it, you mentioned here that you want to make sure that it's not completely equity. So HDFC Balance Advantage Fund as well as ICICI Prudential Balance Advantage Fund, you can put in 30% allocation between these two funds.
Alright, well, next up we have Trisha from Mumbai who's writing to us, and she's planning for her retirement and she's considering mutual funds as part of the investment strategy. Now, are there specific funds or strategies that can help balance risk and returns effectively for retirement planning? That's her question. Gautam, what would your answer be here?
So, great question. I'm very happy that Trisha has decided to invest in equity through mutual funds as part of her retirement planning. So again, I'll just give a cookie cutter portfolio for Trisha to start. It's some of the funds are similar to what I've already said. So ICICI Prudential Blue Chip Fund, large cap fund, so 30% allocation there. Bandhan Core Equity Fund, which is a large and mid with 10% allocation. Mere Asset Mid Cap and HSBC Small Cap with about 25% allocation there. Franklin India Flexi Cap and HDFC Flexi Cap with about 35% allocation there. So that's her 100% allocation complete. The thing, Snehi, that I like to highlight is that when you make these plans, it's extremely important to stick to it. You know, the funds may keep changing, but if you're putting a SIP investment, then you have to stay regular with that and you have to stay the course. And that's really where I see a lot of people falter, that 2-3 years into the journey, they kind of give up or they change their plan and they don't stick to it. And that's really when they're not able to unleash the power of compounding, take advantage of that. You know, they've already put in that much effort. They just need to wait it out a little bit longer.
Alright, Trisha, I hope that answers your query. Thanks so much for writing to us. Next up, Mayank from Delhi is writing to us, and his question is, what types of mutual funds would be suitable for saving towards higher education with a time horizon of 10 to 15 years? Lots of questions we get from our viewers are about higher education. Yesterday, we also had a parent who's planning for the higher education for their child. So, Gautam, what's your take over here? What schemes are you going to suggest to this person?
Great. So because you have a long-term investment horizon, you can go for a pure equity mutual fund portfolio and just make sure that you stay the course like I just mentioned because, you know, 10-15 years is a long time and good to see that you're planning for higher education you know, fairly early. I don't have your age, but maybe you're planning for your child. I'm not sure here. So Kotak Blue Chip Fund, 30% allocation. Bandhan Core Equity Fund, which is a large and mid, put in 10% there. Mere Asset Mid Cap Fund and HSBC Small Cap Fund, put in 25% there. And add a Flexi Cap Fund like HDFC Flexi Cap Fund, where you put in 35% allocation.
Alright, let's move on and talk about a query coming in from our viewer Karan from Lucknow. Now he says, for about 2 years, which are the high credit portfolio but short-term debt funds? It's a complicated question. Gautam, how do you decipher this question and what's your take on this?
So Karan is planning to knock it out of the park with by beating fixed deposit returns by at least 2-3%. And that's what he's asking for. When he says high credit, he means that he's willing to take more credit risk, and he's looking at the short end of the yield curve here by saying short-term debt funds. So Karan, I got you, but just keep in mind the taxation. So please do invest for over 3 years to get in the long LTCG category instead of paying the short-term capital gains tax. So that's why I would say go in for about 3 years. Otherwise, the additional return you're hoping to make through this, you may end up having to compromise a little bit by paying tax on it. So the funds that we are suggesting are 2 corporate bond funds and 1 dynamic bond fund. So about 80% of your allocation you can make to these two corporate bond funds, which is Aditya Birla Sun Life Corporate Bond Fund and Kotak Corporate Bond Fund. And the Dynamic Bond Fund is the ICICI Prudential All Seasons Bond Fund. So the YTMs of all three portfolios are above 7.5%, and their past performance has been short-term performance is okay, but the 1 year, 2 year performance has been reasonable. So these are the funds that we'll tell you to look at.
All right, Gautam, thanks for that. Last up, we have our viewer Ishita writing to us from Ludhiana. She has started an SIP in the funds that are flashing on the screen. Her portfolio is up there. Are these the right funds, she's asking, or does she need to make any changes? Would you recommend taking off anything or adding something, or would you ask her to change her allocation? What's your strategy here?
Yeah, so Ishita has a SIP of 11,000 per month. And I'm assuming that this is a long-term investment. She's looking at least 5 years plus. So that is the lens with which we've seen these funds. HDFC Top 100, SBI Large and Mid Cap, and Nippon India Small Cap, she should continue. ICICI Prudential Value and Invesco India Contra, she should continue. The other funds, we like to make certain modifications, especially because there is too much exposure to small cap segment. She needs to reduce her allocation. So she needs to stop altogether her SIPs in Motilal Oswal Small Cap as well as Axis Small Cap. And these 3,000 rupees that she'll stop putting in these funds, she should shift to HDFC Top 100 Fund, which is already in her portfolio. So her SIP amount will go from 1,000 to 4,000 in the HDFC Top 100 Fund. And the Motilal Oswal FlexiCap Fund, we prefer the HDFC FlexiCap Fund. So she could move that 1,000 rupees allocation from there to HDFC FlexiCap Fund.
Alright, well viewers, that was the last viewer query coming to us, but viewers, you keep writing to us. On that note, Gautam, thanks so much for joining us. I'm going to let you go. But viewers, remember to keep sending us your personal finance and your mutual fund linked queries. Remember, you can WhatsApp us your queries on 865-797-4571, or you can also email us your queries on The Money Show at etnow.tv. But with that, it's a wrap on this edition of The Money Show. I'm Snehi Shah. Thanks so much for watching.
If you like this video, then like, share and subscribe to ET Now.